Okay. All right. So that's fine.
So any questions that were dropped earlier, you can drop them again so we don't miss out on them.
Hello, Yorinde. I think we can start now.
Okay. All right. Let me. Okay. Yes. Okay. So I was on ratio analysis. Sorry for the break. So quickly on ratio analysis, I explained that it's basically a quantitative description or quantitative interpretation of a company's, financial performance. And I said, if I give you a model that contains just ratios for a particular company, it should be able to tell you how that company is performing. And then I told you that the ratio analysis is typically useful when you are doing peer-to-peer comparison and when you are doing trend analysis. So they are trend analysis in the sense that you are comparing on across years for a single company, or peer comparison is when you are comparing one company to another company. Now, there are about 5 key, or let me say 6 key types of ratios that we have. There are 6 types. We'll focus on 5 because the sixth one is more related to valuation, and I'm sure there will be a separate part for the curriculum where you deal with valuation. So I'm leaving out valuation ratios. You come across things like private P, price P ratios, EV/EBITDA multiple, and things like that. But for this class, we'll be focusing on these 5 ratios: solvency ratios, activity ratios, and coverage ratios. Now, don't get bamboozled by all this. We're going to go into them one after the other. I need to be a bit quick, but we'll go after them one after the other, and I will give us, readable materials maybe tomorrow that we can do further study on these items. So let's go quickly, right? First one, profitability ratios. As the name implies, right? Profitability ratios basically are ratios that you calculate to help you measure how well a business is able to generate profit, right? The idea is when I show you profitability ratios for a particular company, it should be able to tell you how well that company is able to generate profits, right? So that's the whole idea, as the name implies. It's basically measuring the business capacity to generate profits for the business owners. And examples of those kind of ratios are, we have we have gross margin, net margin, EBITDA margin. You have a lot of profitability ratios that have margin in front of them. You have gross margin, you have cost margin, net margin, EBITDA margin. Remember what EBITDA means. You can also have EBIT margin and the likes. What do these ratios mean? So I want to pick everything that has to do with gross margin, net margin. Just know it is as a percentage of revenue. So if I want to calculate the gross margin for a company, right? Let's go back to, I don't want you to cram these things. That's why, if you notice, I didn't put formulas. I could have put a separate table and then put formulas for each of these ratios. Whatever material I give you will contain these formulas, and you can easily Google the formulas. The key thing for me is for you to understand the intuition behind each of these ratios. You won't learn these ratios by cramming their formulas. Please don't cram their formulas. We learn these ratios by understanding what they mean, and by understanding what they mean. Basically, when you understand what they mean, you'll be able to calculate them easily without needing to recall any formula or anything like that. So anything that has to do with margin, just know it as a percentage of sales. So let's go back to this slide, right? Let's go back to this slide. Under income statements, whenever you're calculating profitability ratios, a lot of times you'll be focusing on income statements. There are times when you'll be taking things from the balance sheet. Now, gross margin is basically gross profit as a percentage of revenue. So gross profit is divided by revenue, and you convert it to percentage. So that's what gross margin is. EBITDA margin is EBITDA divided by revenue. So anything that has to do with margin, just know it as a percentage of revenue. EBIT margin, or some people will say operating margin, is basically EBIT or operating profit as a percentage of revenue. Cost margin is cost of sales as a percentage of revenue. So PAT or PBT margin or PAT margin is as a percentage of revenue. What all that tells us is, let's give an example. If gross margin is 60%, what it means is that for every 10 naira that a company generates in revenue, 6 naira is going to be gross profit. That is what gross margin tells you. So for every 10 naira the company generates, 6 naira would be gross profit. Now, if let's use PAT margin or net margin or net income margin. PAT that's income that goes to the owners of the business, right? If we decide to calculate net margin, and net margin gives us maybe 30%, right? It means for every 10 naira the company generates or earns in revenue, 3 naira would end up being profits. Now, what this helps you to do is, if you have historical margin, maybe you've calculated for CAP, you've looked at historical margin, and then you notice a sharp, so remember, these things are, I'm trying to teach you to think like an analyst. Don't just look at figures and just take figures as they are. You have to investigate the context behind those figures. So, for example, you're analyzing CAP 2021, you notice that gross margin was, say, 60%. And then in 2022, you notice that gross margin fell to maybe 55%. Gross margin did not just fall by 500 basis points for nothing. Something must have caused it to decline. Now, how do you know what caused it to decline? You have to look at the two components of what makes up gross margin, revenue and gross profit. Now, remember, for you to get gross profit, you subtract cost of sales, right, to get gross profit. Now, if gross margin is declining, two things are likely happening. Either revenue is declining, one, I mean, not two things, I mean, maybe three things. There are a couple of things that could be happening. One, revenue could be declining and cost of sales is stagnant. If revenue should decline and cost of sales is stagnant, gross margin will drop. Another scenario is revenue may actually be increasing, and then cost of sales is also increasing, but cost of sales is increasing at a faster pace compared to revenue. That is, maybe revenue grew by 10% and cost of sales grew by 20%. There is a good chance that because of the faster growth in cost, margins will decline. So because remember, this is a business. If their cost is going up, what they would typically do is that they will pass on some of those costs to their consumers. But if the business, maybe if their consumers, they are in a very competitive industry where if they just increase prices anyhow, demand for their products will fall, meaning there are many other substitutes or cheaper substitutes. The company may be reluctant to pass on the full increase in their costs to their consumers. So what you would see happen is that cost increases and then the increase in revenue is not commensurate. And because of that, the margin of the business will tighten. If you look at Nigerian consumer goods firms, it's something that you will see, that you will observe in their margins. You notice that margins for consumer goods firms in Nigeria in the past few years have tightened significantly. Why? Because inflation has increased rapidly, prices are going up, but because of how, you know, the average Nigerian consumer is becoming poorer by the day, it is difficult for them to just pass on the cost increases to consumers. And as a result, you notice that their margins are declining. And when you're having a decline in your margins, it signifies to me as an investor that your capacity to generate profits in the future is likely going to be troubled. Except there's something that I'm now expecting to change the course. Maybe there's a new economic policy that will suddenly make Nigerians much more richer, and then they'll be able to afford more things. So I use that as an example so that you can understand the whole context behind what a single ratio is. What we've just been explaining since morning is just all the things that can happen around gross margin. So there are so many other things. So net margin, remember, net margin is PAT divided by revenue. So there are so many things that could have caused net margin to either increase or decrease, you know, and it might be taxed. Because in some cases, you might see that PBT will increase, maybe PBT margin increased, but they have to pay more taxes, you know, maybe deferred tax accounting, you know, all those different things. So their tax cost increased, and as a result, their profits, their net income margin declined. So there are so many things that can drive, you know, all these ratios. But when you count, the first thing is calculate the ratios. Know what has happened. When you know what has happened, then you can now begin to look at it. Okay, what could have driven this? What caused this? You know, and then you're able to link it. Remember, in writing your research reports, you are not just writing a bunch of numbers. There will always be appendix where you can put all your numbers in. You are telling a story. You are telling an equity story of either invest or not invest. These numbers are only to aid you in telling that story, not for you to just carry the numbers and write gross margin increased by 500 basis points from 20% to 25%. No, it is for you to tell a story of what is happening. Oh, and are consumers decline? Is the volume, is the demand for their products waning? Why is the demand for the products waning? how is it affecting these financial ratios? But so these financial ratios tell you what could be happening. In medical terms, for example, they check blood pressure, they check sugar level, they check all those things. Those numbers, those medical numbers they get are a signal of the health of the individual. These numbers are a signal of the health of the company. But it is not enough for you to just look at the numbers. You must look at the context behind why those numbers are the way they are. So gross margin, like I told you, everything that has to do with margin has to do with revenue. We have what we call return on equity. Return on equity is basically profit attributable to equity holders. Now, it's important for me to distinguish this. Again, we go back to this. We have what we call PAT here, but in some companies, there are certain companies that are not owned by that, like the shareholders don't own 100% of the companies. We have what we call minority interest. So whenever there is minority interest, you have to back out minority interest from your calculation. Please, I know I'm far, I've overshot my time. So I just want to confirm, can I go ahead?
Hello, Yorinde. I think you can go ahead for about another 10 minutes because I think diminishing marginal returns have entered this.
Okay.
So yeah, it's just another 10 minutes so that we can.
Okay, so I'll finish the ratios, and then if maybe by our schedule, if we can get maybe an extra hour, so that I can do a bit of practical and I can also teach them forecasting, because I think these are the two things that will be left: the practical side and the forecasting. But that's on that. But let me just finish the ratios quickly. So return on equity is basically saying profit attributable to the equity holders. That is, if there is minority interest, you back out the minority interest. So what is left? You now take it and say divided by total equity, total equity. So when you are saying total equity, you also back out the minority interest part. If you are including minority interest in your total equity, then you have to also include, so that is depending on who you are calculating return on equity for. If you are calculating return on equity for the company, then you include minority interest. Let me take that again. If you are calculating return on equity, maybe as an internal person, if you're an internal person in the company and you're just doing analysis, to analyze the financial performance of the business, you include minority in your calculation because your focus is the aggregate company. But if you are a shareholder that owns shares in the company, your focus is only on the profits that is attributable to you. So you focus on only the portion of equity that is attributable to you. So you say profit. So in simple terms, is net profit divided by total equity. In simple terms, your net profit divided by total equity. So when you now have minority interest, you deduct profit attributable to minority interest holders from your net profit, and then you also deduct the equity component for minority interest in total equity. So that's return on equity. So return on assets is basically total profit divided by total assets. So this time around, minority interest or no minority interest, all the total profits generated by the business, divide it by the total assets generated by the business. Return on capital employed streamlines it further. So return on capital employed is saying, let us look at capital that is invested in the business. So in this case, return on capital employed is saying, it's focusing on just debt and equity capital. So it excludes, so instead of unlike return on total assets that includes all other forms of, if you are saying total assets, you are taking, total assets is the same thing as liability plus equity. Remember this. Liability plus equity will give you total assets. If you do subject of the formula, your equity plus your liability will give you total assets. So return on capital employed is saying under these liabilities, just focus on the debt capital plus equity. Don't look at things like accounts payable or all those other components. The focus is on debt, loans, and borrowings. That's the focus of return on capital employed. So it says net profit divided by your what's it called now? Divided by your total loans and borrowings and equity. So that's return on capital employed. I'll quickly go to efficiency and activity ratios. Now, what these ratios try to maintain. So some people say efficiency ratios, some people call it activity ratios. Even if you read some books will call it asset management ratios, but I don't like using that terminology because it can be easily confused with asset management in the sense of asset management in wealth management and things like that. But most places you look, you see efficiency or activity ratios. So for efficiency and activity ratios, the whole idea is how well is the company using its assets and liability to generate revenue. So as a company, you have this huge amount of assets. You look at some companies in Nigeria, they have humongous assets, billions and billions worth of assets, but their revenue is nothing. That means they are not efficient in their operations. They are not efficiently converting their assets to revenue. That is what efficiency ratios try to look at. And one of such ratios is, for example, asset turnover ratio. Asset turnover ratio is basically trying to say your total, what's it called now? Your total assets divided by your revenue. How many times are you turning over your assets? So when you take your total assets divided by revenue, you would get it in. So typically we quote this multiple in times. So if your total asset is maybe 100 million and your total revenue is say 20 million, it means your asset turnover ratio is 5 times. It means for you to sort of generate the value of your assets back, you have to turn over your revenue 5 times. I don't know if that is clear. So it's basically saying if you have assets of 100 million and you have revenue of 20 million, it means you need to do 20 million revenue 5 times to turn over to be able to have your total asset value. If you get what I'm trying to say. So asset turnover ratio, the whole idea, and it applies particularly to a company like CAP that is involved in manufacturing and they are heavy on machinery. So by the time you are collecting money from investors, you are buying all the different machinery and everything. All this machinery you are buying, you must convert it to revenue. So I want to look at how well you are able to convert your assets to revenue, and then you can look at fixed assets turnover, inventory. So anything that has to do with asset turnover ratio, just know that. So asset turnover ratio is total assets divided by revenue. Fixed assets turnover ratio, also known as non-current assets. Remember, under assets, we have current assets and non-current assets. Non-current assets is also known as fixed assets. So you can also call that non-current asset turnover. So if you say non-current asset turnover is total non-current assets divided by revenue, that will give you your fixed asset turnover ratio. Inventory turnover too. Inventory turnover is your total inventory divided by your cost of goods sold. So inventory, in the case of inventory is focused on is looking at how many times are you converting your inventory to sales? Like how fast are you turning over your inventory? But the reason why we don't say inventory divided by revenue is because inventory is measured at cost. Note that inventory is measured at cost on the balance sheet. The cost in which you bought that inventory, that you bought the raw material that you have in your warehouse or in your stock, is that it's valued at cost. So when calculating your inventory turnover, it would not make sense to now compare that something that is measured at cost basis to something that is measured at revenue price or selling price basis. So that's why we say when you are calculating inventory turnover, you say inventory divided by your cost of goods sold. It tells us how many times we are able to turn over our inventory annually. Payables turnover, receivables turnover. So I don't want to just, instead of teaching you receivables turnover, payables turnover, you can see some things that I have here. I wrote DIO, DPO, DSO, and likes. DIO is days of inventory outstanding. I'm sorry, I'm just trying to be quick because there's not enough time. Normally I'm meant to explain each of these ratios one after the other and give you, the formulas and things like that. But so days of inventory outstanding is basically saying.
Apologies, are you in there? So Chairman, suggestion, I thought maybe we should just allow you to wrap it up. But do you think that would you prefer to wrap up today, or would you be open to, all sitting down to look at some other time? Maybe it's a schedule for a future class, maybe in 2 weeks' time or in a week time, definitely before 25th. But just checking what your preference would be. I mean, we appreciate this content so much, and we think, given that there's just still a bit to cover, would you prefer that we probably wrap up tonight, sit down, look at the schedule, and see which other slots we can use to have like a class B for financial ratios? I think Uchichuku is pleading for a future class. I mean, again, so that by the time you share the resources and the slides, the student would also be able to do some homework themselves. And then, I don't know, just wanting to check which you would prefer. What works for you?
Yeah, I think it's best to actually have another session. I think, like Chiamaka mentioned earlier, diminishing marginal, utility is setting in already. The value that everyone will be deriving will be sort of declining and more difficult to understand. Then I'm also having to rush, and so I think we should try and see if we can find another class, maybe an hour, 30 minutes, to just finish up.
Okay, Chiamaka would reach out to you to discuss, and then we can schedule. I think we have a few slots in the future that we can use to drive home. So I think you can wrap up. And Chiamaka, should there be any question, please kindly. For the student, you can drop any question you have tonight so that it can be attended to. But we'll schedule a future class for the last session under the financial analysis. Thank you.
Okay. Yeah. So I think I should let me just stop here, right? And then we'll continue from the efficiency ratios, because I want them to also be able to understand that the cash conversion cycle properly, because it's going to be critical, particularly for CAP as a company itself, that they need to understand because of the model they run, the distribution model and things like that. So I would just continue from there at the next class. So if you have questions based on what we have discussed so far, you can ask questions, maybe drop it in the chat box, and then Chiamaka can read them out and I will answer, and then we can just put a stop there.
Okay, thank you so much, Ayorinde. Thank you so much. This has been very invaluable. We cannot thank you enough. So if there are any I'm surprised I haven't seen any question yet. So if there are any questions, please, I know that we've overspent our time here, but we'll try to wrap up the question section as quickly as we can. So if there are any questions, please drop them in the chat box so that we can attend to them now. If there are any, I'll give about 3 minutes so that if there are no questions, then we can end this session.
Thank you, Shem. So,
Hello?
whilst we wait for any questions.
Okay.
Yeah, so I was saying, whilst we wait, if there are no questions, I think that's fine. I already there okay, there's a question already, but before that, just to note that please, some resources will be shared with you guys, and it will be helpful if you're able to go, to the best, in your own best interest, for you to, go through these resources. Try to also expand your horizon based on what I already has, put everyone through this evening, such that by the time you come to the next class, you can essentially just come with as many questions, particularly in relation to your subject company, for you to best understand how you analyze your subject company. If you can leverage all the information that Aaron has provided today, it will be helpful for you. So in the next class, you can easily just ask very straight questions on your subject company. Thank you. Chiamaka, thanks. Over to you.
Okay, thank you, Samson. That goes without saying. Excel is a very, very important component for this class or for this whole program. So if there's any way we'll also try our own best, but it would be good for everyone to, in their own spare time or in their own leisure, to try to see how they can learn, train themselves on the use of Excel. So we have a question from Chioma Okore. She's asking what the formula for net margin ratio is.
Okay, so like I mentioned earlier, anything that deals with margin, just remember you're dealing with revenue. So net margin is basically your net profit divided by revenue. So net margin could be, it could be, net profit, whatever name it is in the financial statement. Some people will say profit after tax. So it could be profit after tax. But that line item, that profit line item, after you have deducted tax, divided by your revenue. So net income or profit after tax divided by revenue. That's net margin.
Thank you so much. I believe there are no more questions. At least I haven't seen any other question. So that, again, I want to say a very big thank you to everybody, the participant, the facilitator, the volunteers, so for making today's program a success. We will try better in managing our time so that we don't spend 46 minutes more than we anticipated to spend here. So that I think we can bring this session to an end. Thank you very much again, and have a good evening.
All right. Thank you very much, and see you later. Thank you. Good night.